Welcome back to another episode of Smart Portfolio Strategies and Investments podcast. I'm Kerrigan Bale, and joining me, as always, is our Chief Market Strategist, Hale Mercer. And Hale, what a week it's been. We had that Friday sell-off that really caught people off guard.
Hello, Kerrigan. You're absolutely right. And honestly, I think this week perfectly captured why we always say bad news can still be bad news, even when everyone's expecting the Fed to come riding to the rescue. In fact, we keep seeing some really interesting rotations happening beneath the surface.
Before we dive deep, let's set the stage. The Dow dropped 220 points Friday. Sept was down about 0.3%. And this was all on some pretty weak jobs data. But our sentiment readings are telling a more nuanced story, aren't they?
Exactly. Our general market sentiment hit 61.09. That's actually quite strong. But here's the kicker. We are seeing positive velocity at 3.9, but negative acceleration at negative 4.08. Think of it like a car that's still moving forward, but starting to brake.
So let's talk about that macro picture. We had August jobs coming in at just 22,000, way below the 76,600 expected. Bond yields collapsed, and suddenly everyone's talking about multiple rate cuts again until end of 2025 and beyond.
Right, and this is where it gets interesting, Kerr. The 10-year Treasury dropped nearly 9 basis points to just under 4.09%. But what really caught my eye wasn't just the rate move, it was how real estate started moving.
Now, that's fascinating because real estate has been pretty beaten up for the past couple years with all these rate hikes. What are you seeing in the numbers? And by the way, how's BXP doing after your back to office call last week?
BXP is up 7% in just 1 week since I recommended it. That back to office thesis is really gaining traction. But this is where I get excited about the broader story, which we first mentioned in our episode 2 to 3 weeks ago. Honestly, real estate sentiment is sitting at 50.46, so kind of neutral. But the velocity is absolutely screaming at 15.3, and we've got positive acceleration at 1.05. Kerr, I haven't seen numbers like this in real estate for months.
So you're saying the sector is just starting to wake up?
Exactly. And when I look at our volatility indicators, both the VIX and the MOVE index are showing favoring risk. It's setting up this perfect storm for rate-sensitive assets, real estate, utilities, even some of the higher dividend plays are starting to get institutional attention.
Let's shift gears to earnings because we had some real standouts this week. Broadcom absolutely crushed it, up over 9% on AI revenue growth of 60%. But then we had some real disasters too.
Broadcom was the poster child for what's working right now. That 60% AI revenue growth isn't just impressive. It's validation that the AI infrastructure build out is real and sustained. But then you flip the coin and look at Lululemon.
Ouch. Down 19% on tariff worries and what they called stale product offerings.
And that tells you everything about where we are in this market cycle. Companies that have their act together, like Broadcom partnering with OpenAI on custom chips, they're getting rewarded big time. But if you've got execution issues and macro headwinds like tariffs, the market is absolutely ruthless.
What about Macy's? That 20% pop was pretty surprising.
Macy's actually gives me hope for some of these turnaround stories. Best quarterly comparable store sales growth in 3 years. That's execution. And in this environment, when a company shows it can actually execute on a plan, investors are willing to pay up. It's rewarding operational excellence.
All right, let's get tactical. You've been looking at the sector rotation, and I know you've got some strong opinions about where money is moving.
So here's what's happening. We're seeing this interesting divergence. Financials are sitting at 70.7 sentiment, which sounds great, but the acceleration is negative 6.84. Translation, institutions might be taking profits in banks before rate cuts actually hurt their margins.
That's counterintuitive. Wouldn't banks benefit from a stronger economy?
That's the classic playbook, but with a big if, as we have CPI and PPI data next week. If rate cuts are coming, net interest margins will get compressed. Smart money is rotating out of financials and into rate-sensitive plays like real estate and utilities.
And utilities are sitting pretty at almost 80 sentiment.
79.82 to be exact, with flat momentum. That tells me it's purely defensive positioning, but here's where I see opportunity. Energy is sitting at just 41.3 sentiment, but showing 18.67 velocity.
We'll talk about your energy pick later too, but now on the defensive side, you've got some sell signals too.
Consumer staples is flashing warning signs everywhere. 43.21 sentiment, negative velocity of negative 2.78, negative acceleration. When defensive sectors are getting sold, it usually means either people are feeling really optimistic about growth or they're worried about something else entirely.
What's your read on that?
Honestly, I think it's rotation. Money managers are saying, if rates are coming down, why own boring staples when I can own growth or rate-sensitive plays?
Hale, here is the moment we all have been waiting for. I want to dig deeper into your 3 top picks this week. You've been really focused on trend confirmation signals, and you've identified as your standouts. Let's start with public storage, PSA.
PSA is the textbook example of what happens when fundamental shifts align with technical momentum. We're showing a buy signal with a 4.05 profit factor and 52% win rate. And those are exceptional metrics. But here's the deeper story. Public storage is the largest self-storage REIT in America, and they're hitting a perfect storm of catalysts.
Walk us through that storm.
First, self-storage is recession-resistant. People downsize, they store stuff. Economy improves, people move more, they still need storage. Second, with rates coming down, PSA's cost of capital improves while their dividend yield becomes more attractive to income-focused investors. Third, they've got tremendous pricing power, over 2,400 facilities across 38 states. And here's the kicker. Real estate as a sector is showing 15.3 velocity with positive acceleration. PSA isn't just riding individual fundamentals, it's riding a sector rotation wave.
So you're seeing both the macro and micro stories align?
Exactly. This is trend confirmation at its finest. Technical momentum supporting fundamental value in a sector that's just waking up from a 2-year hibernation.
Next up, Pool Corporation, POOL. This one surprised me because consumer discretionary has been so choppy.
Pool is this week my favorite contrarian play within a recovering sector. 3.07 profit factor, 62% win rate, but the story goes way deeper than the numbers. Pool Corporation isn't just any consumer discretionary company. They're the dominant distributor of swimming pool supplies and equipment with about 40% market share in a highly fragmented industry.
That sounds like a pretty specialized moat.
It's an incredible moat. Once you install a pool, you're a customer for life. Chemicals, equipment, maintenance, upgrades. And here's what people miss. Pools are typically installed during economic good times and maintained regardless of economic conditions. With rates potentially coming down, we get a double benefit. New housing activity drives installations, and existing pool owners have more disposable income for upgrades and premium maintenance.
And the sector backdrop is supporting this?
Consumer discretionary sentiment is at 61.08 with positive velocity of 2.87. The sector is rotating from defensive to growth-oriented names, and Pool has both the defensive cash flow characteristics and the growth leverage to housing recovery. It's the best of both worlds.
Finally, Valero, VLO. Now, this is interesting because last week you were recommending Marathon Petroleum, MPC. And energy took a beating this week with all the rate cut talk.
Yeah, I'll be honest, energy got whipsawed this week. The unemployment miss had everyone thinking recession fears, lower oil demand, and while the major integrated oil companies like Exxon, ConocoPhillips, and Chevron sold off 5% this week, MPC is actually slightly positive. But here's why I'm doubling down with Valero. They're not an exploration company. They're a refiner making money on crack spreads, not oil direction.
But aren't you worried about the same volatility hitting Valero?
Look, energy sentiment is sitting at just 41.3. Nobody loves the sector right now, and that volatility you mentioned is exactly why. But here's the thing. If we get hot CPI or PPI data and next week, this whole aggressive rate cuts narrative could flip overnight. Suddenly, energy looks cheap again, and Valero is showing a 2.37 profit factor for a reason.
So you're betting on an inflation surprise changing the narrative?
I'm betting on Valero's operational excellence regardless of the macro noise. They've got some of the most sophisticated refineries in the world. They can process heavy, sour crude efficiently, and with energy sector velocity at 18.67 despite weak sentiment, there's underlying rotation happening that most investors are missing. Sometimes you've got to buy when others are selling. Plus, you're getting nice 2.8% dividend kick on the side.
Now, you mentioned aggressive versus defensive strategies. How should people be thinking about position sizing with these three picks?
Great question, Kerr. First and foremost, positioning should be according to each investor's risk tolerance and specific financial goals. For aggressive accounts that can handle more volatility, I'm overweighting these trend confirmation plays because they've got both fundamental support and technical momentum. But for defensive accounts, maybe you take smaller positions and use some of those high conviction short plays we discussed earlier as hedges.
And the profit factors you're showing, how should retail investors interpret those?
So here's the thing. Profit factor above 2.0 is decent, but for true institutional grade signals, we're really looking for profit factors above 8.0 with a solid history of closed positions. Unfortunately, those institutional grade setups don't come every week. That's why we use a risk-adjusted formula that combines profit factor and number of trades to determine appropriate position size.
That sounds pretty sophisticated. How does that work in practice?
Well, PSA at 4.05 profit factor with 52% win rate over multiple trades, that gets more size than something with a 1.5 profit factor and only a few historical trades. We cover all this data in detail for our institutional clients, along with other proprietary metrics that we're looking to release to the broader market soon. The key is matching position size to signal quality and your personal risk parameters.
All right, Hale, looking ahead to next week, we've got some potentially market-moving data coming up.
Absolutely. The big one is the Bureau of Labor Statistics releasing their preliminary revision of jobs growth from April 2024 through March 2025. Now, downward revisions are expected, but if they're severe enough, we could actually see talk of a jumbo rate cut at the September 16th to 17th FOMC meeting.
And right now, the market's pricing in what? Basically certainty of a quarter point cut.
Quarter point is essentially baked in with about 8% odds of a half point cut according to CME's FedWatch tool. But if these job revisions are really ugly, that 8% could jump significantly.
We're also getting PPI Wednesday and CPI Thursday.
Right, but here's the thing. Inflation data has taken a back seat to labor market concerns since Powell's Jackson Hole speech. The Feds clearly shifted their focus from fighting inflation to supporting employment. So unless we see some shocking inflation surprise, I think the jobs data matters more.
On earnings, we've got Oracle Tuesday, Adobe, and Kroger Thursday. Anything there catching your eye?
Oracle's going to be all about their cloud transition, and AI capabilities fits right into our tech momentum thesis. Adobe could be interesting for their AI content creation tools. But honestly, I'm more focused on how these broader macro data points might accelerate the sector rotation we're already seeing.
Hale, last thoughts for our listeners heading into next week.
Stay nimble, Kerr. This market is rewarding precision right now, the right sectors, the right names, with strong technical setups that are confirmation of bigger themes playing out in real time.
Perfect. Thanks, Hale.
Thanks for having me.
Well, that's all for our weekly wrap. Remember, this is general market commentary, not personal investment advice. Do your own research, manage your risk, and we'll see you next weekend for another Smart Portfolio Strategies and Investments episode. I'm Kerrigan Vale. Until next time, trade smart and stay safe.